So today's topic, liquidity risk and the money market. Mainly we talk about liquidity risk and liability management. So we basically continue from all the problems that we already saw last week. So we'll go over liquidity management, interest rate risk management. We know interest rate risk is coming from interest rate changes, which are affecting asset prices, liability management, and a little bit of asset management. Now they all go hand in hand, but of course I can't explain them all at once. That's the reason why we go through them step by step. But just sometimes you might wonder, why do I just focus on one side of the balance sheet here? It's simply to simplify it right now. In the end, we need to look at the overall balance sheet. So a little bit of recap, where we're coming from. Last week we talked about the bank, and the bank is doing certain kinds of transformation. So on the asset side, they've got long-term loans that are not liquid, they can't be sold easily. Long-term bonds, they can be sold, but they're long-term. And they've got credit default risk, risky loans here. But on the liability side, they've got deposits, which are very liquid for us. We can withdraw them anytime. They're considered short-term, and also the bank promises us to repay everything, so they're considered low risk. And out of this transformation, so the fact that the bank is financing these risky long-term assets with these short-term liquid funding, there are certain risks for the banks. And one risk is liquidity risk, so that people want to withdraw their deposits, and the bank simply doesn't have enough liquidity. And we have to manage that. We have to make precautions for that kind of risk. So this is very similar to what we did last week, but we're going to be a little bit more in detail. So don't get shocked that I repeat everything. It's going to be more detailed. So what's the risk of illiquidity? Sometimes I say liquidity risk, sometimes I say illiquidity risk. I mean the same thing, and I'm not going to be touchy if you say that too. Basically, liquidity risk or illiquidity risk means you've got too little liquidity on your balance sheet. As in this example here, so this bank basically doesn't have any reserves or cash reserves anymore, zero. And they still got lots of short-term, very liquid deposits. Remember, again, deposits are not lying around. This is a promise that the bank makes to its customers. So it's tricky to promise the customers that they can withdraw any time $90 million if you have none on your balance sheet. So what can the bank do? They can ask for an interbank loan. They can ask the central bank for a loan. They can sell securities or reduce loans. And we go through each of them step by step now. First thing is interbank loan. So we ask another bank for a loan. Basically, we borrow 9 million exchange settlement funds from another bank, so we get the 9 million here as an asset. But at the same time, because we borrowed it from the other bank, we owe it now to the other bank. We've got a liability to the other bank. So that's the reason why it's going on both sides. The balance sheet simply gets longer. And now this bank has much less risk of illiquidity, because I've got 10% of the deposits they could cover here by basically cash or ESF. Now, what's the disadvantage of this approach? They have to pay for that one, right? So they have to pay, let's say, for one single night, an overnight loan from another bank. In Europe, it's called the Euro Overnight Index Average Interest Rate, EONIA. In Australia, that's the famous cash rate. So the cash rate is the one that is in the news all the time because the RBA is fiddling with it too. The RBA is setting a certain target for the cash rate. And in macroeconomics, when they talk about interest rates, they often talk about the cash rate too for monetary policy. So that is a very important interest rate in Australia. And the cash rate itself is basically the cost of overnight interbank loans. So if one bank is lending to another bank, or if one bank is borrowing from another bank, the interest rate is called the cash rate. In the US, the same thing is called the federal funds rate. So it's also overnight between banks. Also a very, very famous interest rate. And in the US, also the central bank is targeting this interest rate here. So it doesn't come for free. For the US, we've got some data, actually quite a lot of data. So what do we have here? The brown line is the target rate. So the central bank in the US Fed, is setting a certain target where they want to have the overnight interest rate between banks to be. And that is the brown line here. And we can see over the last few years after the financial crisis, pretty much the actual interest rates are on the target. So the actual interest rates are the blue lines here. And we can see here, early on it was pretty close to the target, but not 100%. And here in the year 2007, now things starting to get interesting. Because what does this one here mean? This one means that the official interest rate between banks, or the target rate between banks for one single night, was just under 5%. But there was at least one bank that had to pay 15% for a single night lending. Now, why might that be? So it's just for one night, so we can't use duration or time to maturity as an explanation. We're just talking about a single night. So what's the other one? So we've got the term structure, and we've learned about another reason why interest rates might be different. Another kind of risk. So if you give money to another bank, there's always a chance that by the next day, they simply don't give you the money back. They might go into default. It's a very low risk. You would think that if you give some money to Westpac or NAP, that they're still around tomorrow. But here in the year 2000, there were at least some banks in the US that were considered very, very high risk. So they had to pay a huge risk premium. And this is really big, right? If you think of it, it's a 10% risk premium for a single night. That's a lot. And on the other hand, there are some banks that were considered very, very safe, and they pay even less than the target rate here. Good. So for the US, they have published all these different interest rates. They don't put the name of the banks there, because otherwise you could imagine what happened to the reputation of this bank. If you hear that your personal bank has to pay 15% for one night, maybe you're not so convinced that the bank is safe anymore, and you do a run-up. And as soon as people run to the banks, banks can't survive it. Bank run can never be survived by a bank easily. In the US, they've got over a few thousand banks. So I think at the time they had 3,000 different banks. So if you publish information like this and you don't put names onto it, it wouldn't help you much. You don't know which of the 3,000 banks is in that much trouble. In Australia, different. Right? In Australia, we basically talk about the big four. So if you publish information like this in Australia, people would try to guess which of the banks is in trouble. And therefore, in Australia, we don't have this data available. We only have the target line available usually, or the average of all the banks, but not the individual ones. I think you all heard about the global financial crisis. I'm not going into details today, but you can see it here already. So during the financial crisis in 2007, 2008, there was a big upheaval here in the banking sector in the US. And interest rates were going really, really high. Not the official interest rates, they went down, but actual interest rates that some of the banks had to pay. Right, so these banks, of course, huge trouble, paying 15% just for one night. The second option is we just borrow the money from the central bank. So, for example, from the Reserve Bank of Australia in Australia, or the Fed in the US, or the ECB in Europe. Looks the same thing here. We get our ESF funds. Just on the other side, instead of interbank loan, it says now borrowed from the RBA, 9 million. Same story as beforehand. We have to pay interest, but there's something slightly different. So the RBA is charging the target plus 25 basis points. So 0.25%. This bank has to pay on top of the target cash rate. So let's say if the target cash rate is 1.5%, but this bank wants to borrow from the RBA, they have to pay 1.75%. So it's a bit more expensive. At the ECB in Europe, this one is called the so-called repo rate. And banks usually need very, very good collateral. So they can't just rock up and say, listen, we want to borrow money. But they have to put down bonds or security as collateral, as safety for the other bank. Third one here, security sales. So we had here beforehand 10 million of securities. So instead of somebody asking to borrow some money, we can simply sell some of these. So in this example here, they sold 9 of them to another bank, and they got paid 9 million in ESF. But therefore, of course, they don't have 10 million in securities on their balance sheet anymore, but just 1 million. Now, what's the disadvantage of that one? Number one, we have to pay fees, right? Plus, it can be quite inconvenient if the bond prices, for example, went down. Or if you have shares, if you sell them when price is very, very low, you have to realize a loss. And that might be, not exactly profitable. Good. And the last option, you can try to reduce loans. So some loans you're able to call in, very difficult though, or every single day there's some loans rolled over by the bank. So there's always some loans that get repaid, and therefore the bank is giving out new loans to other customers. And in this case here, what the bank could simply do is, once a loan gets repaid, they simply don't make a new loan. And therefore the total amount of loan goes down, and their reserves go up. But that might be tricky for customers. I mean, if a customer just repaid a loan for a car or a house or business loan, and then say, I've got another business idea I want to do, can I borrow money again? And the bank says, no. That's not going to be very nice to the customers, and there's a good chance that the customers are going to another bank afterwards, and you lose the customer forever. So it's costly in that sense too. Another idea might be to sell these loans, and we talk more about that one when we talk about the global financial crisis. But selling loans is very difficult because other banks usually don't trust the loans that you want to sell. Due to asymmetric information and adverse selection, usually the banks would choose to sell their worst loans. And the potential buyer knows it, and hence is not very interested in buying loans directly from the bank. Source of liquidity, we can take precaution by just having some cash already, cash and ESF. So that's the most liquid asset we have. We can have some treasury securities also on the asset side. So these are government bonds that we can sell very easily. They're also very liquid. And something is called certificates of deposits. Now very carefully, these certificate of deposits, these are not these deposits here. When they say certificate of deposits as liquidity reserve, what they mean is CDs as a security. So certified deposits you can imagine as like mini bonds, and they're being bought and sold in the market. So the bank can either issue them and have them as a liability, or a bank can buy certified deposits, and then they're just another security on the asset side, and they're considered fairly liquid. So basically the first ones are all buffers on the asset side. Some liquid assets that you're holding there, just in case that you have some withdrawals. And the alternative is borrowed liquidity. So this is a repeat of what we had just beforehand. So you can borrow from another bank or another central bank, or you can also make, it's kind of borrowing a repo. Now what does a repo mean? It's a so-called repurchasement agreement. Saying it very simple, it's exactly the same as borrowing money, but you have collateral with it. And I think the easiest to understand that one is practically. So let's say if I want to borrow $1,000 from you, and you want to earn interest, of course, too. I could just borrow it, but you don't trust me. So instead of borrowing money from you, we can do a repurchasement agreement. I'm selling you today my laptop for $1,000. And we make a contract that I will buy it back next year for $1,100. So you get my laptop for 1 year. I get you $1,000 for 1 year. Next year, I'm coming with $1,100 to you. I get my laptop back, and you get my $1,100. What was the interest rate in my example? 10%. And can you see how it's exactly the same as a loan? There's only one difference. If I'm running away during that year, what security do you have? What kind of collateral? So if I'm running away, you still have something valuable. And that's the reason why lots of central banks and other banks are insisting on repos, repurchasement agreements, just that they, of course, don't use MacBooks. So they use government bonds usually. And they often don't do it for a year. It just shows a year that we can calculate the interest rate very easily. They just do it for 1 day, for 1 week. But the idea is exactly the same. So they're selling a bond to somebody else, and they are promising to buy it back at a higher price, so including interest, in the near future. And there's something called reverse repo. That's simply the other side. So where somebody is buying a bond with, at the same time, the contract that they can sell it at a certain price in the near future. Good, so don't get scared by these big names here. It's not that hard what's behind it. So when we want to manage our liquidity, we basically often have to do a trade-off. So the nice thing, for example, about ESF, cash, and government securities is they're very, very liquid. They're helping us if we have sudden withdrawals. But if you think of ESF, if you have ESF sitting on your account, lots of it, lots of reserves on your account, so you're very liquid as a bank, but what's the disadvantage? How much interest rates can you earn on this one? What's the return on ESF? Very, very low, right? When we talk about monetary policy, we will see it's, I think it's 25 basis points under the target cash rate. But it's a very, very low return. Let's think of cash. If you have cash in the vault, can you take a guess what the return then is? Do you earn any interest if you have cash lying around? No, right? That was an easy question. Now, if I have a few $100s in my wallet, that's not too much of a deal. But for a bank, if they have a few $1 million in the vault, it actually costs quite a bit too. So they have to have security personnel around, they have to count it, they have to recount it later as soon as somebody else was down there, and they have to pay insurance for the cash that is lying around. So cash is quite a hassle for banks. Banks usually don't like cash. That's the reason why they want us to pay payless, cashless, with card and our telephones all the time. So yes, these things are giving us liquidity, but unfortunately they don't have a high return, and in fact they might cost us something too. So that's a trade-off that we have here. Next one here, government securities, also very liquid. So Australian government bonds, for example. But again, we have a very low return on these. Right? So it's again a trade-off. On the opposite side, business loans, they get a much higher yield, or mortgages is getting a much better return for the banks, but now these things are illiquid. So depending on how the interest rates and the market is, you have to decide how you want to strike the balance. Should you have most in mortgages or most in cash? How much cash should you have compared to deposits? 2%, 10%, 20%? Well, it all depends upon. And one thing it depends upon also is liquidity regulations. So the government set regulations for it too. There is something called the liquidity coverage ratio, and we just touch it roughly here. It basically says that each bank needs to have enough liquid securities on its asset side that they can cover the average net cash outflow for 30 days. So let's say you're a large bank. On an average, you've got $20 million. Oh, that's way too little, but I'll make up the number anyway. $20 million in 30 days flowing out. That means you should have at least $20 million in exchange settlement funds and government securities on the asset side, just in case. And then there's something called the net stable funding ratio. And that says there's a certain ratio between the assets and liabilities. It's easier to see in the thing. Right? So beforehand, the liquidity, we're basically talking about the reserves here. And net stable funding ratio basically says if you have assets that are stuck on the balance sheet because they've got long maturity, for example, these loans, you should not finance them with very, very flimsy short-term liabilities on this side, but you should finance them with something that is a bit more stable. So in this example here, maybe you have a little bit too much deposits and too little bank capital. Maybe you should have a few liabilities here that are also long-term. For example, savings accounts or term deposits. Something that can't rush out immediately. And by the way, here's something interesting. So for us, usually we say deposits, we can withdraw them any time. But practically, it's very, very unlikely that in any day all the depositors are coming to the bank at the same time. So usually retail deposits from your regular mum and dad business, there's some flowing out, some flowing in, but they're considered fairly stable, these deposits. There's some other liabilities that are not on this balance sheet, but which you can imagine. If this bank is borrowing large amounts on the money market from other institutional investors or from other banks for one day, overnight, or for a week. Now, these other banks, they are much more sensitive to changes in interest rates or to changes in the market. So the chance that they withdraw 10 million in one go, much bigger. Right? So there's certain things here on real banks' liability side here that is more flimsy. And the regulation says you should have not too much of them. So you should have long-term assets somewhat covered at least by long-term liabilities. So there's less illiquidity risk. If you get the general gist of these, I'm happy already. Good, but now I want you to think a little bit, and I've got you a little bit of help here again. So let's imagine you're a liquidity manager, and all you care about is basically the liquidity of that bank. And now there are certain things happening here. For example, the variability of deposit in and outflows is increasing. So some days you get more deposits, and some days some more deposits flow out, but it's basically harder to predict what's going to happen tomorrow. Or this one here, the yield on non-liquid assets increases. For example, loans. Loan interest rates go up. Here, liquidation costs. So if you're selling a security, the cost, so the losses of a sudden sell, is increasing. And the last one is borrowing liquidity from somewhere else. It's getting cheaper. So to get answers for these, what should you do? I think it's useful to think of these questions here. Number one is, did the risk increase? Or did the costs increase of illiquidity? And what should you do now? Should you have more ESF buffer, just in case, or less? And should you do more liquidity transformations, or should you create more deposits and more loans, or rather less? So let's see. So the first one is basically how much risk there is. If we don't know how much deposits are flowing out tomorrow, the risk is higher that there's more flowing out than we thought, so we better have a little bit more cash or ESF around. The second, yield on non-liquid assets increase. So this is a little bit separate, right? It doesn't say how risky it is for deposits to flow out or for deposits to be withdrawn. It doesn't also say how costly it is to fix the problem of liquidity, but it implies something else. It tells us how costly it is to hold cash. Because if you hold a lot of cash and ESF, it at the same time means that we cannot buy these non-liquid assets. Just imagine, for example, if there's corporate bonds that are hardly traded and they've got a return of 12%, really good. But instead of buying the bond, you have everything in cash. That means you're missing out on 12% return. And that's not going to be very good for your profits. So the higher the potential return for your assets, the less cash you want to just have idle lying around, because the opportunity cost is high. Liquidation costs, so this is in case now that things went wrong and you need to get something liquid very quick. So in this example here, you sell your non-liquid assets, but it's going to be very expensive. And therefore, it's better to have more ESF straight from the beginning. And the last one is the opposite. So now, even if you're running out of party food, even if you're running out of ESF and cash, it's very cheap to get some quickly. So there's no point of having too much lying around in the beginning. So the whole point here is there's no fixed formulas of how banks are creating their balance sheet, of how exactly, which kind of assets and liabilities each bank has here. Each individual bank, NAB, Westpac, Commonwealth Bank, they all look at a million different interest rates in the markets. They look at the customer base. They have statistics running, how much deposits are flowing out, in and out on normal days. They're making estimates, and then they're deciding how much reserves should we have. How much should we put into loans? Should we increase our amounts of loans, or should we decrease the amount of loans? Should we buy more government bonds? Should we buy more corporate bonds? It all has to do with the interest rates and the interest rates differentials. So you can imagine if interest rates for government bonds and corporate bonds both go up by 2%, then there's not necessarily a need to change the ratio between government and corporate bonds. But you would think, okay, if these assets earn a higher return, what would you change then on the asset side? If securities earn you more money, what do you do with the reserves, more or less? You use that money to buy government and corporate bonds, of course. Now I change it slightly. I say government bonds stay the same, but corporate bonds go up. Now two things happen. Number one, because corporate bonds give you a higher return, maybe some of the cash is going into corporate bond security. But number two, maybe also the bank thinks, wait a second. Yesterday, bonds and government and corporation paid roughly the same. Now the corporate bonds are much better, so I might sell some government bonds and replace them by corporate bonds. So what I'm saying here is the banks constantly adjust their assets and liabilities depending on the returns and the risks. And there's no fixed formula for it. I'm trying to give you a little bit of a feel of what they're watching out for. That's the reason why we do these U-turn. So we've got that already. The reason why they hold cash and ESF is because if you get illiquid, it's costly. Liquidity buffer helps, cash and ESF, as I said before. Liquid securities and government bonds are fairly good too, because we can sell them very easily, and there's not too much cost involved in selling them. Liquidity management is basically a matter of finding the optimal mix between returns and liquidity. Innovate, so that is coming up with new products sometimes too. And we talk about that one, especially when we talk about securitization. So we just push that aside. But if you heard about securitization and subprime bonds, mortgage-backed securities, that has to do also with liquidity management. So the bank's got a new idea how they can make something non-liquid liquid.